a step-by-step guide on how to sell a business. In this video, I'll be going over a step-by-step process on how you can sell your business when you decide to exit. So I'll try to make this video as brief as possible, but also as detailed as possible, if that makes sense. I'll try to cover all of the bases. I've got my notes from which I normally use from the coaching. Obviously the coaching goes into a lot more detail, but I'll be using the same notes to go over the business sales process. So the first thing that you need to understand about selling your business is that you need to identify what is the reason that you are selling your business. Now, of course, this is different to every single individual. However, there are some recurring themes that come across while I advise my clients on why they want to sell their business. Of course, retirement is the biggest one. And the second biggest one is normally health problems, unfortunately, which isn't the best reason, of course, to sell, or not a favorable circumstance. The other reasons why someone wants to sell is if they're younger, normally because they want to cash out the work that they've done. It could be that they want to cash out, they haven't got a buyer on the table, and sometimes it is that someone has approached them on wanting to buy their business, so therefore they've got a good offer, they're happy with that offer, and therefore they want to go and sell that business. And that's a fantastic reason, of course. All reasons to exit your business is going to be personal for you. Now, I'm not going to be going over the different types of exits on how people can exit their businesses if they want to. But what I will be going through is that if you want to sell your business, actually selling it to a third party, then how that can be done. Now, this assumes that it's not your employees, it's actually a completely different party to yourself. Maybe it's another business, another person, maybe it's a private equity group, something like that. This is the process that we'll be covering. So you need to, once you've identified your why on why you're selling your business, because that can inform what kind of business process you want it to take. Remember, someone who's selling their business for retirement, who's later in their age, for example, maybe in their 70s, and someone who's selling for retirement, maybe in their 50s, that's two different situations there, and that's two different methodologies that you might want to use depending on what your own goals are. So that is really, really important to understand the why. Once you know the why, then you can start taking the deal. It's more about the deal structure more than anything else, because the selling process is actually the same. Whether you're selling retirement when you're 70 years old, whether you want to cash out the business, the rest of the process is the same. It's about the deal structure more than anything else. So let me just go to my notes. So once you've got clear on why you're selling, the important thing to understand is how long is it going to take. I've got another video on my channel which talks about how long it's going to take, and that all depends on what's the current state of your business in terms of how much preparation time is required in your business, which is different. Go and watch that video if you want to find out more about how long it might take to prepare your business for sale. But the next logical step, let's assume that your business is prepared to sell right now. So let's assume that case. Generally speaking, it takes anything from 6 months to 18 months. Average time is around about 12 months to sell a business from the point of you deciding and your business is prepared. Now, actually, how do you know that your business is prepared? Well, hopefully you've been watching the videos on this channel so you can understand what it takes to prepare a business for sale. But also maybe you've spoken to an M&A advisor and they have advised you that your business is actually ready for sale. Now, this is a really important point. Choosing an M&A advisor, you need a team to sell your business, right? And we're going to go into that very now, in fact. So you need a team to sell your business. One of the people that you should have is an M&A advisor. Now, there are a whole array of M&A advisors out there. There are people who go onto the low end of the market. When I say low end of the market, anything below 100,000. But if your business profitability EBITDA is below 100,000, then you're on the lower end of the market. If you're above 250,000, now there's a bit of elasticity there. You could be doing 200,000, but you could be considered low end of the market. It all depends on your industry as well. What's the average in your industry? So normally 250,000 plus, you start going into small business, not micro business. They're micro businesses, the lower end of the market. Then you've got your small business. You've got different types of M&A advisors which are there, business brokers. Then you've got people on the lower end of the market, lower medium-sized business market, lower mid-cap as it's called. That's where I operate, small business and lower mid-cap. And Then you got your actual mid cap, where you're going from sort of 50 million in revenue up to 250 million in revenue. The principles are approximately the same, but there's a few different considerations when it comes down to the actual middle market. So you got different M&A advisors that operate there. What you need to look for in an M&A advisor, and I'm pretty sure I've got another video on the channel, and if I haven't, I'll be making one. So by the time you're watching this, there'll be one up there. Is that the right business broker, the right M&A advisor is absolutely key. And also the right accountant, the right lawyer, the right wealth manager, the right financial planner, the right tax accountant. All of these, you need to have the right people who understand what it means on the structure of the deal that you want to do, on what advice you need. So that's really important. And actually, I would say if there's, the M&A advisor is really important there, because if the M&A advisor that you have is good, they will normally have some people within their team, within their network, that they know, okay, you haven't got an M&A lawyer, then here's an M&A lawyer. You haven't got an M&A accountant, here's an M&A accountant. You haven't got a wealth manager, here's a wealth manager. So they will have that team there. Like I have a team behind me who can actually advise my clients, and sometimes I advise my clients. I actually prefer that my clients use their own existing teams that they have. But if they're not up to the job, and normally I'll have a conversation with the accountants, I'll have a conversation with the lawyer, I'll have a conversation with the wealth manager. Wealth managers are normally best to deal with. They're quite good. Accountants and lawyers, however, they have their own specialisms, and that's why it can be a bit of a challenge. So as long as you have the right team, so choosing a right M&A advisor is absolutely key when you are selling your business. The next person that you need to speak to is a tax accountant, because the biggest thing, which is the biggest cost that you're going to have when you sell your business, is taxation, right? So you need to have the correct tax advice. Now, there's some tax rules that you could benefit from when you're selling your business, depending on your particular situation, on what are you selling, what's the value of what you are selling, have you sold anything before? So all of that plays a factor whether you can actually benefit from some of the tax mechanisms which are out there. And of course, it's different for every country, every jurisdiction. So I know more about the UK than in the US or Canada or South Africa or Australia. But of course, if you're in any one of those countries, you need to speak to your own tax specialist. Now, that's the thing. The M&A advice is the same across the globe. So whether you're selling a business in the UK, or whether you're selling a business in the US, or whether you're selling the business in New Zealand, it does not matter. The process of selling the business is the same. However, what changes is regulation around taxation, regulation around the local markets. So that's what you need to take into consideration. Now, once you've got your tax, I'm gonna be looking at that. So you've got let's say you've taken your tax advice, or you've got a good tax accountant there. You've chosen a good M&A advisor. You need to really look at your accountants and lawyers. So there's the second part of your team. Your accountant and your lawyer needs to have deal experience. When I mean deal experience, I'm not talking about property, unless property is part of your equation. But and actually, yeah, we'll talk about that in a second. So if, for example, your accountant is really good at tax management, that might not be correct for selling a deal. You need to have someone who knows how to present documents which are right for getting the best value out of your deal. You need to have a lawyer who understands business transactions, because if you have someone who is really good regarding IP, that person will not be the correct person. That lawyer will not be the correct lawyer to actually sell your business. Why? Their specialism is IP. They don't know what it takes to sell the business. It's a very specific set of skills, especially on the legal side of things. So having a great team is going to be really, really important to your track record. Now, if property is part of the equation, then you need to get a property valuer, a real estate agent, or a estate agent who understands the property values on the market. And also, this goes into why you're selling. If you're a property landlord, if you own the property, then you need to plan around that. Most business buyers don't want to buy freeholds. They want to buy leasehold businesses, which means that they're not going to be buying the building from you. Some business acquirers do want to buy buildings, but most don't. So you need to take that into consideration as to what's going to happen with this property when you go to sell your business. Right. So now you've got everyone around you, then you need to get a valuation done. So the valuation forms, let's say around the business, Property valuations are actually quite easy because once you've got your property, your real estate agent, your estate agent who has identified the value of your property, you've got that there. That won't change too much depending on how long it takes in the process and how much the market has changed in the property market. However, the business valuation is really unique to your business. Every single business is unique in its valuation. You can have two businesses with exactly the same revenue and exactly the same profit. However, they have two different valuations. It's unbelievable. So that's why you really need to go deep into your valuation. And this is where unethical business brokers, unfortunately, and there's a lot of them out there, they will overprice your valuation, and that actually negatively impacts you. You might think, oh, an overpriced valuation is great. Now, by the way, just here, if you're in the small business side, especially micro business side, there will be a valuation which will be attached to your business sale. If you're top end small business, so if you're between 5 and 10 million in revenue and good profitability on that, or you're in the middle markets, lower mid market or mid market, the valuation is more your information as to where your bottom line is going to be, right? But valuation prices are not published to buyers. Why? Because if you've got a mid-cap business, let's say you've dominated a local area, a geographical area, now you've got a monopoly on that area, your business might be more valuable to one buyer as opposed to another. And it also depends on your goals. I mean, business owners do have some ideas as to who they want to sell their business to. And that's something you have to speak to your M&A advisor about. Is there something which like you're really passionate about that I will definitely not sell to this kind of company, or I will definitely not sell to this type of person? And that's up to you, of course, that's individual bias. I would say you should take emotion out of this transaction. Why? Because emotions run extremely high, especially when it comes down to the end of the deal process. Take emotion out of it and put your business cap on. Just like you've been running your business as a business, put your business cap on when it comes down to selling your business as well. Because if you get emotional or emotions start playing a part in your business sale process, it's going to be really, really difficult to navigate the process itself, but also to get a good deal, because the buyer will be able to sense that from you and then they will capitalize on that opportunity. So take emotion out of it, but you've got your valuation, which for lower mid cap businesses is for your information only, and say, right, this is the bottom line, I don't want to go below that, and you will then go out to market. So you've got your valuation now as well, you know what to do. The next thing that you need to do is to understand the types of buyers. So of course there's different types of buyers out there on the market. I don't think I'm going to go too much into detail as to what the different types of buyers are, but let's just go very quickly. You've got your private individual, let's say someone who wants to run a business themselves, but instead of starting one, they want to buy one. You've got your small business who wants to buy another business. You've got your strategic buyer, which is a larger business that wants to buy your business. Then you've got financial buyers like private equity, venture capital firms, not venture capital, but private equity firms, holding companies which might want to buy your business. So they're the types of buyers that you'll have available. So you can choose right. And actually, it's not just about choosing, because your business might not be right for a financial buyer. It might only be right for another small business or a private individual, where there's another business which actually suits more strategic and private financial buyers. So financial buyers are looking for certain criteria, right? Does your business meet that criteria? If it doesn't, then you can't even approach those types of buyers, because they're just not going to be interested. So again, you have to work with your M&A advisor to identify which type of buyers might be suitable for your business. Once you've got your type of buyers that you have, you need to start marketing your business. Now, your M&A advisor, if you're working with one, will be able to come up with some marketing materials. By the way, you don't need an M&A advisor to sell your business. You can actually sell it yourself. People on my coaching, there's a few individuals that do want to sell their business themselves. They do save quite a bit of money, because M&A advisors are not cheap. They're quite expensive. They will end up taking a portion of your sales price plus an upfront fee, and depending on the size of your business, also a recurring charge. So if you do sell I don't advise, by the way, selling your business by yourself, but if you do decide to sell the business by yourself, then that marketing process is really, really important. There's particular stages that you need to go through in the marketing process. And there's other things that can be done. I mean, like, depending on how much time you have. Some people, of course, need to sell tomorrow, or yesterday, I should say. And some people don't mind waiting 12 months, 18 months, even 2 years, 5 years to sell their business. And the longer time you have in terms of planning, in terms of what you can take to get your business ready and put it through the process, actually, that's the better situation. So you've got teaser documents in which you just show the most basic information without actually disclosing what your business is. Now, you can send out those documents without an NDA, non-disclosure agreement. Those documents don't disclose your business name, they don't disclose anything about your employees or your customers. It just talks about industry, turnover, profitability, and general team size. It doesn't say anything else. So what that does is that enables you to push out that material into the marketplace, depending on who's right for your business, and then you can get some interest back to say that, okay, let's say there's 100 people who are interested in my business. By sending that teaser document, that's what that can do. Then of course, they and you will be sieved down to maybe, so for example, 20 individuals once you send your NDA. So after your teaser document, you can have a conversation with those people, they can have a conversation with you, find out how many people are left who are interested in your business, and those people who are left, let's say there's 20 individuals for this example, you send an NDA document out to all of them. You do that before you send out any further information. After you've got your NDAs back, your non-disclosure agreements back, then you can send out more detailed marketing information. Now, buyers want to see certain information to see whether it meets their criteria. So it's really important that you are putting the correct information in there. Now, I don't have time in this kind of video because this video is going to be long just by going through the process anyway of what needs to go into the marketing materials. But of course, a bit more detail regarding your financials, a bit more detail regarding your organization, the name of your business, of course, is going to go in there. Oh, in your teaser document, obviously, is going to be your industry and sector too. Your sector or industry, I should say. But then you can go into detail about who your target market is, who you serve, what geographical area you're in terms of a bit more specific. The teaser document will give a general thing about geographical area. And then you go more specific about your business. So you can disclose more information for those people who have signed an NDA. So they definitely want to see the profitability. They definitely want to see your team size. They definitely want to see your industry, how many customers you have, those kinds of things. Pictures and videos work really, really well too. That if you've got pictures and if you've got videos, then that is absolutely fantastic. Now, actually, I should backtrack a little bit because I missed a point here. You need to start creating a data room. That more goes into like preparation. That's when I'm working with my coaching clients, I talk about that more in the preparation. We really talk about a lot about preparation in the early stages because the more you can prepare, the better value you can get out of your business sale. But the preparation side is data room. You need to start uploading all of the necessary information into a data room. So your financial accounts, anything to do with accounts, anything to do with organizational structure, all of your supplier contracts, all of your customer contracts, some information regarding your team needs to go into this data room. So you need to collate a data room. Why? Because once the NDA gets signed, why did I backtrack from the NDA? I'm just giving information. Because the data room will make it easy for you to give that information. It's really, it becomes quite a lot if you're having to email all of these documents. If you collate a data room and then you've got that password protected, then you can also specify, it's really important that you specify who's allowed to access that data room, right? So you send the link, and you give them the password, and there's ways in which you can restrict that access too. So you restrict it to the most important people in the other organization, and then they've got access to all of your data in terms of the data that you've uploaded into that data room. So once you've got that, then they can make an assessment. Now, buyers make a complete evaluation of your business as to whether it's something they want to move forward to. So remember in our example, we started off with 100 people who were interested with the teaser document. Then you've got down to 20 people who signed an NDA. And let's say, for example, people have gone through your data room and you've got maybe 2 or 3 individuals, businesses I'm talking about, who are left who want to go ahead and pursue this even further. So then that's when it starts getting interesting. So you vet your buyers too. So out of those 20 individuals, it's not just them saying no to you, you say no to other people too, other businesses. So you vet your buyers, and vetting your buyers is not just about saying, okay, who would I prefer to sell the business to? It's also about, do these people have the capability to actually close on a business? Because you'll be surprised how many owners are out there who don't actually have the ability to, when I say owners, I mean people in institutions that don't have the ability to close on a transaction. Now, I'm not talking about people pulling out of transactions, because actually a transaction can be pulled out of for many reasons. Maybe they've gone through due diligence and they found something and they want to pull out. That happens all the time. But what I'm talking about here is that you just vetting who you want to deal with. And that's why it gets whittled down from 20 to 2 or 3. So you've got that. You've vetted your buyers, and that's absolutely necessary to do, just to save your time. Remember, you're running your business at the same time as selling your business. So once you're vetting your buyers, you're saving yourself so much time and unnecessary headache and heartache in the process of selling your business by vetting them. So you've got that. Then you've got offers and negotiation. So of course you invite the offers from the people who are interested. Now you could invite offers from the 20 people stage after you've vetted the people that you want to deal with, or you can invite offers from the 2 or 3 people that are left over. And the best thing to do is to pit them against each other, to let them know that there are other parties who are involved in bidding on your business. Now, you don't want to be too brazen about it. You need to do it with some subtlety. So you let them send their offers in and you say, right, I'm reviewing this offer against some of the other offers that I've received. That's what you do. And by the way, you do that even if you've only just received their offer first, and that's the only one you've got on the table, because there are other people who are waiting to send offers in. So you're going to evaluate that. You're going to see, right, what is this? And of course, as a seller, you understand, or you should understand anyway, that never accept the first offer that you get, because they're always going to be trying to lowball you, or most of the time they're going to try to lowball you. There are some acquirers who will give their first offer is their offer, the offer that they want to pay for your business, and the structure as well. And if you don't do it, then they'll walk away. And that's fine. Remember, you can always start this process again. And that's why I say the longer time you have to take to sell your business, the better it is, because you can go through this process a couple of times before you actually find someone. I know there's one business seller who went through the process 3 times of sending out teasers, getting the NDAs, getting the people who he vetted, getting the people down to 1 or 2. When I say 1 or 2, 1, then he said no at the end. Then it went again the second time, then the other person said no, the buying party said no. Then the third time, that's when this transaction was successful. So again, you can go through this process a couple of times to find the right buyer for your business. So that's that. So you got your offers and negotiations. Now, once you've got the offers that you like, you will get an LOI or heads of terms, right? HOTS, you call them in the UK. In the UK, you call it heads of terms. In the US, Canada, and to be honest, everywhere else, you call it a letter of intent. It's also can be called indicative offer letter. So whichever term it is, it doesn't matter. It's about, getting that into writing. So this document is a document which the basic bones of the deal, the basis of the deal goes in there, the most fundamental details. So price, structure, exclusivity. So by the way, the LOI or the heads of terms is not a legally binding document, and it doesn't crystallize the purchase price, the sales price of the business. What it does do, there's only 2 things which are legally binding: the non-disclosure, which of course you already have non-disclosure, but that reinforces it, and also exclusivity. So you need to be careful not to sign away too much of an exclusivity period. Your exclusivity period, I would say no more than 90 days. If they ask for, let's say there's a particular situation going on in which you understand, they understand, maybe 120 days maximum, but 90 days would be there. And if you can actually get less, because don't forget, the buyer doesn't have no commitment to actually buy the business, even with the heads of terms or letter of intent in place, the LOI in place. So that's why if you can reduce the exclusivity period down, let's say to 60 days, then that's great as well. And again, before you even sign a heads of terms document, a HOTS document, or an LOI, what you need to do is you need to make sure that the buyer has the ability to actually transact. So they've got proof of funds which are there, or many buyers, in fact, not many buyers, almost all buyers will use some sort of leverage to buy your business, meaning some debt. So as long as they've got a letter there saying that, right, I have this letter of intent from a lender or investors to put in to buy your deal, that's also proof of funding too. So that's great. But you want to do that before you sign yourself into exclusivity, because once you're in exclusivity, you can't deal with any other parties. Otherwise, that will be a breach of contract and is bad faith, right? So you want to be ethical when you're doing these things. Right. So once everything goes into the heads of terms letter of intent, it's really, really important that you get the definitions correct in that, because if you don't have the correct definitions in there, like let's say you've got a business term, like when I am dealing with people that I want to buy their business from, I'm very, very particular about assets in terms of what is net current assets. What is that? What does that mean? Right? So we go into a lot of detail to have a definition on that. Now we have our particular documents that we use, of course, but we go into a lot of detail on that. So it's really important that you understand. For example, if they say you have a non-compete, what's the definition of that non-compete? Are you now restricted that you can't do something for forever? Is it 2 years? Is it 5 years? What is it? Is it for a geographical area? Is it globally? Right, so you need to be really, really careful, because let's say, for example, you're slightly younger and you're looking to sell your business and you have a non-compete in your industry, and they might say, right, you can't do business in this sector anywhere in the world. But hold on a second, you might be deciding to move to another country. Relocation is another reason why people sell. You might be deciding to move to another country. Now, if you've got a local business and they've got a non-disclosure. Now, to be honest, if that ever went to court, the judge will just throw that out because it'll be ridiculous. But you need to be careful about these things, right? So you need to be careful about the definitions of what's going into your heads of terms, into your LOI document. So once you've got that, you can present that to your lawyers. Now, people have different circumstances. You can get your lawyer involved before you sign the LOI and the heads of terms. It depends on how much experience you have, depends on how much experience your M&A advisor has regarding that, and whether your M&A advisor wants to even get involved in that, because some M&A advisors, bad ones, again, mostly business brokers on the lower end of the market, they don't even get involved in that. It's unbelievable that sometimes I'm dealing with my clients and they're saying, no, my business broker is saying that you just deal with it directly. Hold on a second. What are you getting the advice for then if they're not going to be able to look at the most basic document, right? And we're not talking about the actual sales agreement. We're talking about an LOI, heads of terms. Trust me, it's not a big document. It's a few pages. Anyway, coming back to that. So you can get your lawyer involved at this stage before you sign it, or you can get involved after you sign it. It's up to you. I would prefer that you get your lawyer involved from the beginning. Why? Because if they understand the basis of the LOI, the basis of the heads of terms document, then it will be so much easier for them to draft or deal with the purchase agreement, the sales agreement, when you're selling your business. So that's why it's really, really important. Now, the other thing you need to consider is whether you're going to be selling the assets or the shares, right? Because that also goes in there. You're going to consider what's going to happen with the property. That's all going to go into the LOI and the heads of terms document. So all of that goes into that. So it's really important you work with an M&A advisor and see your business. If you're an online business, you might only be, have a 3PA, what's it called? 3PL, yeah. 3PL provider who's doing all of the logistics for you. That's fine, because then you don't own any property. There's not even someone that you're leasing from. It's that you've got an agreement with them to actually take care of your shipping. So that's fine as well. Now, one other thing that you need to take into consideration is your lawyers and your accountant. So your accountant needs to be part of the LOI heads of terms too, because when they're looking, they should understand the deal structure and they need to understand what's going in there. Again, this is why planning the type of exit you want to do is really important when you're talking to your tax advisor, your wealth advisor, your accountant, because that will all help when you are going to sell your business. Right, then it goes into the actual due diligence stage. Due diligence, unfortunately, is not the best time for sellers. Buyers actually do a lot of evaluation. Now, different buyers are different, of course, and it also depends on the size of your business. But Buyers generally go into a lot of detail when they're evaluating your business. They will check everything. You've got your documents up in the data room. They're going to ask for more documents normally, especially if they've got experience within your industry. They're going to ask now industry specific details, licenses, accreditations, contracts. Everything is going to be evaluated. Fire safety, health and safety, all of these, insurance, everything's going to be evaluated. That's why the more you can put into your data room before, it's going to help you here because you have all of this information available. So the due diligence will be conducted, financial due diligence will be conducted on your business, legal due diligence will be conducted on your business, operational due diligence will be conducted on your business. So it's really important that you have a thick skin at this point. See, M&A advisors, they don't actually support most of their clients. I always like to support clients when they're going through the due diligence process. Why? Because it's emotionally scarring. It's brutal. It's a brutal process because, again, imagine everything. Things that you forgot about. Things that you done 20 years ago, which are integral to ensuring that your business is running. That's why it's being checked, of course. But all of a sudden, someone's coming, right, I want that document from 1989, for argument's sake, right? Now, where is that document? Did you have it in paper format? Where is it? Is it lost? What's going on? So you need thick skin for that period, for that time, and that's why a good M&A advisor will support you. Now, the M&A advisor is not going to be there holding your hand. They've got other clients to deal with as well. Even me, when I'm with my coaching clients, I'm not holding their hand through every single part of their deal. But if my clients are asking me about something or they're just feeling overwhelmed, I'm there as a helping hand to ensure that, right, this is normal part of the process. You just need to navigate this, your emotions too. You need to navigate emotions. You need to navigate this process like this and just let it continue. So that's the due diligence. While the due diligence is going on, they're also going to be doing the sales agreement. So that normally comes from the buyer side. And again, it's different if it's an asset sale or it's different if it's a share sale. Excuse me. What you need to do is you need to go through that as well with your lawyer. Now, this is the part where I would say an M&A advisor should not get involved because it is a legal document and the lawyers will have the most current and up-to-date information with regards to what goes into there. There are a few things that your M&A advisor can just advise you with regards to getting you some protection, because remember, when you're selling your business, you're not selling yourself with your business, right? So you need to be protected as an individual. When it comes to marketing your business, right? So the first half of your business sale, you're protecting your business, which is also you. You're protecting you and your business. But when you get to the point of the LOI heads of terms thereafter, you're protecting yourself more than your business, right? So you need to be really, really wary of that fact. Now, sales agreement has been done. Let's go. Right, so there's things like reps and warranties, disclosures as they're also called, disclosure documents, legal documents, SPAs, APAs, all of that. We don't need to go into that. That is really detailed stuff. Completion accounts, again, you can't go into it into a video like this. Maybe I'll do another video on that later on. But you've got completion accounts. Which type of completion accounts are you going to be doing? Is it lockbox? Is it actual completion accounts? Again, that's a whole different conversation and it's quite detailed, but you need to look at what kind of accounts are going to be prepared and what you're going to use for that. And finally, the completion of the sale. So it's really important. Actually, sellers pull out of deals more than buyers pull out of deals. Buyers pull out of deals early on. Sellers pull out of deals later on, and it costs money, right? So you would have spent so much in legal fees by this point. You'd have spent so much in accounting fees by this point. You'd have paid an M&A advisor. You would have paid a tax advisor. You would have paid your wealth manager so much. And then right at the end. That's why it's really important that you know that selling is the right thing for you. And that's why I say you need to really do a lot of upfront work in the sales process and choosing the correct buyer for your business and whether you are comfortable with that. Because the last thing you want to do is when you get to signing day, you end up feeling what's called buyer's remorse. And you pull away from signing the deal, right? So it's really important. And again, ultimately it's your choice. You don't have to sell your business, remember. But ultimately it is your choice. But what's the point of going through this entire process and then, of course, at the end, you pulling the pen off the paper and saying, no, I don't want to sign this deal. So let's say you have come to completion and you are completing the business. You sign your documents and you've sold your business. Fantastic. But now you need to look at what you're going to do post completion, and that's why you want to sell your business early on is really important to understand why. Because post completion, there's different things that can happen. You might stay on. There's always going to be a handover period. No one immediately exits unless, unfortunately, you die in office, right? Or something really terrible, you're terminally ill. That's different. But if, for example, when I say you die in office, you're not going to be selling the business, your children are going to be selling the business, or your inheritor, whoever that person is. But what are you going to do post-sale? If you're going to stay on, then there's other agreements that need to be had, right? My advice is never stay on. Handover period, that's it. Job done. Leave. Why? When was the last time you had a boss? Unless you've been through the process a couple of times and you're selling to private equity, because private equity will want you to stay on for after the sale and continue to run the business for them. They're financial buyers. They're not operators. Unless, for example, there's a clear plan that, okay, you've told them, I want to exit and I want you to find an operator, and they find someone immediately, which is unlikely because they want to see in handover what's happening in the business, then that's different. But I would advise that just exit yourself from the business after a very short handover period, whether it's 3 to 6 months, no more than that. There are people who, now if you're younger and you want to carry on working in the industry, then that's different. Maybe you want to stay on, but make sure you have a very flexible package from them and you're not employed. Keep it open-ended from your side and their side that you can end the agreement whenever you feel like it, right? So that's really important post-sale. Now, if you are exiting from the business, it could be that you sell and you exit, and let's say they've got a succession plan, or you've succeeded your plan, you prepared your business well, and you've got a great succession plan there, then you can actually exit later on. Now, what happens after that? What happens post-sale? What are you going to do? Of course, you're going to celebrate because you got a good windfall of cash into your account. And of course, don't spend the tax money. Always keep that aside. But you got windfall cash, so you're going to celebrate, take some time off, take a break. But you need to be aware of your emotions. Because remember, let's say you've been running this business for 20 years and all of a sudden now you've sold your business. You're not getting up and going to work anymore. You're not getting up and being busy like you were before, right? And you're so like me, and you've got a PA who does most of the work for you and a team which does most of the work for you. Most business owners are not like that. Most business owners are owner-operators. And owner-operator, it doesn't even mean you're an owner-operator. A lot of business owners, most business owners are heavily involved in their business in some way, shape or form. And you're going to miss that. You don't think, unless you're completely burnt out, that's different. Then you want to take a step back and that's fine, fantastic. But you need to have a plan post-exit. If you don't have a plan for yourself post-exit, you're going to have a lot of depression. I'm not saying that you will have a lot of depression, but in a lot of cases you have depression. Whether it's a small amount or whether it's a large amount. If you think about it, the stories that we hear is mostly about athletes, right? Because they retire young, yes? So they have a very successful career from, let's say, 18, 21 years old, all the way up to, 30, 35 years old. Normally, that's when, definitely you're sort of retired by that point. Only in a few sports do you carry on till 40, 45. After that, you're gone. But what are you going to do? You see, a lot of these athletes get depressed later on because they don't know what to do. They've had the limelight. They've had so much activity. And then all of a sudden, they're retired. They've got money, you will have money, but it's not about the money. It's about what you're going to do day to day. So having a plan for post-exit is really, really important. So that's the business sales process step by step. Of course, there's so much in the middle which I've had to miss out because you can't go through absolutely everything in one video like this. We'll be here and I'll be going through all of my slides, hundreds of slides that I go through with my coaching clients. By the way, I don't go through all of it with my coaching clients because sometimes it's not relevant for them in their particular situation. And that's something which, if you work with an M&A advisor, the good M&A advisors only give you the information that you need for your business. There's no point having overwhelm, right? Just on information. Obviously, we do deals all the time. So that's why we know a lot. And that's a different level of knowledge that we require. But you don't. You need what's right for you and your business sell. So I hope that's great. And if you want to find out more about how to get some coaching when you want to sell your business, then click some of the links in the description and you can apply to work with me, and let's see if we can work together. Otherwise, best of luck with your business exit, and I'll see you in another video.